All right. So, Clive, you are looking at interest rates tonight because globally, we are finally starting to see the trend of central banks cutting interest rates. So what's going on?
Yes, well, the interest rate hike, this new monetary tool began because a certain crisis hit the global economy. First, it was COVID, which slowed down the pace of production, and therefore, because the logistics issues of prices started to run up. And then after that came, of course, the Ukraine-Russian war, which significant commodities, major commodities, including energy, were stifled, from moving from one place to another, especially in Europe. So inflation just spiraled out, was spiraling, about to spiral out of control. And one of the most popular tools to control inflation is to hike interest rate. It's called a monetary tool. How do you do that? Through the financial structure mechanism. The Monetary Authority, the BOJ, who really heads and guides money supply, prices, etc., regulate banking institutions, financial institutions, hike interest rate. When you hike interest rate, you pay more for loan, you pay more for services. When you borrow, you lease, anything, you'll pay more. And that higher prices tend to slow down demand. So that's the idea behind that. But it's a very complex process because there are many units, departments, sectors, industries that are impacting in different ways and means. And people also react, different economies, different sectors react differently in terms of impact within a time space. Some lag, so it's a very complex process to manage. So over the last years, we've seen inflation rate in many of the major economies, especially Europe, England, Euro, the United States, very high. And they use the policy rate, or what we call policy rate in Jamaica, what the US call the Fed rate, or what is called the base rate in many economies. That is the most basic interest rate, how financial institutions borrow from the bank, the national bank of each country. And that rate goes up. It means that banks will off-lend money to their end users, to you and I, businesses, at a higher rate. So they use that as one of the basic tools. There are many other monetary tools, but that is the most basic ones. So they've done that over the years to contain inflation, and it has managed in some quarters, especially in the European Union, in England, in Canada, and in the US. It has managed to somewhat slow down demand, slow down economic activity somewhat. The US has a very robust economy. And by doing that, prices have somewhat tempered, right? And prices in certain areas. And once that is, bringing down prices is not just a one-off thing. It has to be over a period of time. It has to be stable. And it has to be in a space where it can be controlled and monitored or influenced by the monetary authorities. If it runs out of control, we're in problem, So once it is in that space, then the monetary authorities can begin to lower interest rate. That is, increase the money supply. By lowering interest rate, people can borrow more. So when people can borrow more and spend more, the money supply increases, and that helps to spur economic activity. But
right.
It must be.
So who's setting the trend right now, Clive? Because there have been some moves recently to lower rates globally. Mm-hmm. Who's setting that trend?
Yeah. Well, the European Union, of all the major economies, in fact, Japan had begun slightly increasing interest rate, but they're coming from a negative interest rate, right? Where demand, was just not sufficient to move the economy. So they are slightly different. But the European Union, coming out of an inflationary period, just recently dropped interest rate by 25 basis points, or what we call 0.25%, right? And that is expected to stimulate the economy. Canada also has increased interest rate, but they are a little
increased or reduced?
Sorry, the reduced interest rate. But their economy is slightly not in the problem that the US economy is in. What impacts us mostly, though, is the United States rate. We're closely linked to the US. We trade with them. Trade meaning physical merchandise goods. We export largely to them. We depend on tourism, remittances, so financial transactions with them. And also our money, capital moves quickly and easily because of our correspondence banking relationship. It's easy to move money to the US. So the fear is that if the US interest rate is higher than ours relatively, then we may see a lot of Jamaicans who, incidentally, what I learned probably a year and a half or two ago, is that I think upward to 47% of all savings in Jamaica is in hard currency, particularly US dollars. So it means that easily these persons can move money to the United States and therefore cause a capital drain here and perhaps further
that
inflation.
much.
So that is why we have to wait sometimes upon the US or kind of match or predicated on the movement in the US interest rate. That is significant to us. Not necessarily the euro, yes, Canadian, yes, but the US. 62% of our trading activity are with the United States of America. Much, much lesser on the England, the European Union, and Canada.
I don't know. Did you see our interview with the BOJ governor, 2 weeks ago, Clive?
Did not see it, yes, but I've seen a few others where he had spoken about various things that impacts monetary policy and the broader economy, yes.
Yeah, so we were asking him outright, when will you reduce interest rates? And he, didn't really want to give a commitment or a timeline. But I think, if I remember correctly, he said he expects it within the year. If I remember correctly, I hope I'm not misquoting
you. You may have heard correctly. That is the thought or the words being bandied around, that by year end we may see some movement in interest rate. It might be very small, maybe negligible, but enough to translate right throughout the economy. But as I indicated, we are fairly stable. I think Jamaica was perhaps up to 3-4 years ago in a better stead than the US. There was still, the hotel sector was doing well. Remittance was hit for a while at the peak of COVID, but recovered quickly by 2021, 2022. Our bauxite sector was just reviving. Our agricultural sector was doing fairly well, fairly okay. So we were in better stead. And I think we implemented our monetary tool, raising interest rate, I believe, earlier than the United States. So we had a handle of it. And also our regulatory mechanism was well intact and structured from the 1990s, way before many first world countries. However, we are a small economy, a dependent economy, an importing economy, and one that is heavily dependent on the US, where capital easily flows between. So we still have to be, very aware of where their interest rate is, so we can, at least make some decisions on ours. So again, yes, it looks fairly stable here. We have managed last April, up to April, the figures produced by the MPC, by the BOJ, sorry, or Statin, or PIOJ, that I think it's Statin that monitors inflation rate. April, it was 5.3 percentage points year to year, from April 2023 to April 2024. And that is down from the peak we had, I think, the month before, probably over 6%, which is way above the range that our government and BOJ regulatory authorities deemed appropriate or best for the economy.
So with all that said, question coming from Philip, who wants to know, so can Jamaica justify cutting rates before the US Fed?
I don't think we would. I don't think we will, and we would do it. We are very much predicated on them. That has been our behavior, and I think that will continue. I don't think we will cut before them.
All right.
Can I just add a couple of cents there, Kalila?
Go through, David.
So if anybody's actually sat down to check the schedules of the US Fed versus the BOJ, the BOJ literally is always like a week or two after the Federal Reserve carries out their action. So it's to kind of show you the relationship that Clive is talking about, in the sense that it's like Jamaica is going to say, all right, we're the bigger, tougher boys, we've cut inflation, time to just move quickly. That's not likely to happen, because there are different factors that have to be taken into consideration. At the end of the day, if you cut too early and if you start to spike again, you can have other issues. And the reality is, there have been different changes in the economy over the last couple of years. So, for example, Clive referenced, the dollarization of our economy, in the sense that about 45% or in that region of deposits are foreign currency based. When you take it a little bit step further, we just had the adjustment in the minimis, that duty-free rate, from $50 to $100 US. Now, there's the one side of the equation where customers won't earn as much from the duty that they are charged to go about the $50 region, but this also potentially is an indicator, but potentially a space to have further imported consumption. So the different actions that are taken by the government, which is fiscal policy, also impact the BOJ decision in how they dictate their monetary policy. So there are two parts to the equation. So while the government may pursue an expansionary policy based on their particular desires or needs, the BOJ also has to account for the GOJ's standpoint, the US standpoint, and any other factor that can potentially disrupt and cause inflation to rise again. Because someone else kind of mentioned this before, but inflation disproportionately affects the poor a lot more than it does what you'd call the regular middle class. So for some persons, they've seen the cost of transport potentially going up from 120 a couple months ago to 150 now, which is an extra $50 per trip. If you take 4 trips per day, that's an
officially, because unofficially some providers are charging more.
Of course, but that's what can be done. You need to reach home, but essentially $150 per day. Over 1 week, that is basically $600 basically. So I'm just kind of linking all this back to show that every action has to account for further events later on the line. So we saw last year, June, where the Dominican Republic Central Bank cut their rates at 50 basis points. We saw, the Bank of Canada and the European Central Bank cut rates last by 25 basis points. And tomorrow, the US CPI is coming out, which is the US Consumer Price Index, which is basically inflation metric. And the US Federal Reserve is supposed to announce their decision tomorrow. Now, you're having different banks, or analyst firms such as your Scotia banks, your Goldman Sachs, and so forth, saying that they expect they expect inflation to come out around 3.2% as the median range or the expected figure. So, leave it to be 7:30 here in Jamaica. That's going to be the time you're going to see everybody looking out to see that data come out. Because if inflation comes in hot, it can be a problem. Inflation comes in line with expectations, or inflation comes below everybody's own estimates, that's a good thing, because it can give further credence to potential earlier rate cuts, which is great for many parts of the economy. But different economies move quickly or adjust in different ways to what you'd call rate cuts. So even if we have rate cuts tomorrow by the BOJ, for example, it might not immediately percolate to the economy that quickly. And the BOJ's decision for this month is set for June 20, which is about 2 weeks from now. So a lot of technical discussion a while ago on monetary policy, but the simple of it is that the central bank's mandate is to maintain price stability and financial sector stability. And
well, we'll be interested to see what they announce on the 20th, if there is any change.
28th.
The 20th, that's 28 or 20?
Yes, 28.
Oh, on the 28th. All right, so we'll be looking out for that. Thanks, David.